Welcome to an introduction to accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. In this series of podcasts we are going to look at some of the ideas behind bookkeeping. We will start with the idea of debits and credits. Our current accounting system began over 500 years ago when bankers used to lend money to merchants, and merchants would repay the bankers when they had their goods and had sold their goods. So the bankers had to keep records of the money they were lending out, and the merchants needed to record the loans they had taken out. So let's say, for example, a banker loans £1,000 to a merchant, so the banker's cash account is £1,000 lower, and you have to record what is owed. The Latin expression for what is owed or what is due is called debitum, and from this we have taken the word debit. The merchant has received £1,000, so the cash account for the merchant is now £1,000 better. So the merchant has been entrusted with the £1,000 by the banker, and the Latin to be entrusted with is creditum. And so from this we have taken the word credit. So here then were the original origins of the use of debit and credit. The banker records that their cash account has decreased, but the money owed to them has increased. The merchant records the fact that their cash account has increased, but the money they've been entrusted with has also increased. So it doesn't matter whether we look at this transaction from the viewpoint of the banker or the merchant, there is still a dual nature to the transaction. And that dual nature led to the phrase the double entry method of accounting. Now let's look at it in more detail. The banker set out accounts to show money collected, money being paid out. The money that had been paid out was from the bank account, and so we can see what we have done is credited the bank account because they've entrusted that money to someone else, and they have debited a debtor's account because they have someone who owes them £1,000. Entries on the left hand side of the bank account became known as debits, and entries on the right became known as credits. And you eventually find that for all accounts, entries on the left were called debits and entries on the right were called credits. The merchant's double entry is of course that he has then a debit to the bank account of £1,000 and a credit to the creditor's account because he's been entrusted with £1,000, and he becomes the banker becomes a creditor because money is owed to the bank. So a person that owed you money is known as a debtor, but a person that you owed money to became known as a creditor. Now that was fine, except that merchants soon realised they needed a little more than that. They needed to record what they paid for goods, and they needed to record the sale of the goods. And so, several hundred years ago, a man called Pacioli came up with an extension of the dual effect system to accommodate this, and as a result he's become known as the inventor of double entry accounting. In fact, he's more likely to be the first person who made a full record of how to carry out double entry accounting. So, recording a purchase of inventory using a double entry system meant that the merchant, if he used £1,000 to purchase goods intended for sale, well, his bank account would have a credit of £1,000, and the inventory account would have a debit of £1,000. So he had £1,000 worth of inventory. If the merchant then sells the goods for £2,000, then that sale can also be recorded as a double entry. £2,000 has been received and paid into the bank account, so that is a debit of £2,000. So the opposite effect must be a credit of £2,000, and that goes to a sales account. And you're probably picking up already the idea that debits will always equal credits in any particular double entry. When the merchant repays the banker, to whom he owed £1,000, there will be a credit to the bank account of £1,000 and a debit to the creditor's account of £1,000. Now, If we look at the accounts for the merchant, there is still a problem, because there was still £1,000 in inventory. But quite clearly, those goods aren't there. Those goods have passed to a customer. So that although those are the entries so far in the bank account, the creditor's account and the sales account, they're not complete. We need something else. And so the solution was an account that recorded the cost of goods sold. So to show that the inventory was no longer there, we have a credit of £1,000 to inventory and a debit of £1,000 to the cost of goods sold. Now let's suppose that the merchant has to pay a ship's captain for the transport of the goods, and he pays him £200, which is an expense. So we need to record the expense, so it's £200 credit from the bank. In other words, the bank account is lowered by £200, and the debit goes to a shipping expense account, a debit of £200. So you can see expense accounts now, if you put debits in them, they increase the expenses. So the picture that is emerging is there are accounts of different types. There are accounts which show what the merchant has. Those are the bank account and the inventory account. And that type of account became known as an asset, right? An asset representing what a business owns or what a business has. And there are accounts to represent what the merchant owes. Those are creditors' accounts. So what a business owes is called a liability. Right, so liabilities accounts represent what a business owes to other people or other businesses. So that leaves sales, cost of goods sold, and the shipping expense. Okay, let's see if we can make more sense of this. If we take the sales account and subtract the cost of goods sold, then we're left with £1,000. We then subtract the additional £200 for expenses, the shipping expense, we're left with £800. So the sales minus the cost of goods sold is £1,000. Now we take the £200 expense and we are left with £800, and so the balance in the bank is £800. So that represents money that the merchant has made. So the money made is termed the profit. So sales, cost of goods sold and expenses are associated with profit and loss. And a profit increases the value of a business. So the idea behind accounting became that if you had what a business has and you subtract what it owes, that gives you what a business is worth. And the term for what a business is worth became called the equity of a business. What a business has was an asset, what it owes is a liability. So if we took assets, subtracted liabilities, we're left with equity. And that is known as the accounting equation. That ends our first broadcast, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies.